In this video, we're going to look at Invesco Mortgage. Invesco is a REIT, and what I do in my videos is I run a discounted cash flow model. This way I could figure out the intrinsic value of a stock to see if it's a buy or a sell. We also look at financial ratios at the end of the video. So let's get started with the model. This company has a market cap of $597.2 million. So I'll put that in. And let's see what they're trading at. They're trading at 366. And then next for the model, I need the free cash flows. And I'll go back to Yahoo Finance to pull that. And free cash flow is the cash that's left over after operating a business minus capital expenditures. And this is how you value a company. You estimate the future free cash flows and discount that number back to today's value. And that's what we're doing in the video here. Now I'm pulling net income. And that's the profit and loss according to the income statement. And we also need the revenue, the sales of the business. And the sales for a REIT are the mortgage and lease payments they receive from their customers. Let's take a look at the numbers. Free cash flow looks pretty good. They do have a negative net income and negative revenue in 2018. Not sure how that could happen, but hopefully that doesn't screw up the numbers too much. Now let's look at that capital structure. So I had to pull some information from 10K because Yahoo Finance didn't have everything. So I didn't find their long-term debt in Yahoo Finance, so it's $19.2 billion. Let's get their interest expense, and that's $472 million. And let's get the beta of the stock. That's the volatility of the company's stock. So Yahoo Finance doesn't have a beta for the company. I'm going to put the beta at 2 because it looks like it dropped a lot recently and it could be pretty volatile. And next we're going to get the equity for the company. That's the total value of the business according to the balance sheet. That's total assets minus total liabilities. And the equity is $2.9 billion. Put that onto the model. And we need the EBIT, earnings before interest and taxes. And for this company, that's just going to be their revenue. It's $408 million. So now we figured out their weighted average cost of capital. It's the blend of cost of debt, 2.46%, and cost of equity, 18%. That's 4.48%, the weighted average cost of capital. And that's what we're going to use to discount the future cash flows. So we estimated 4 years of future free cash flows. We also did a terminal value, which is all years past year 4. We discounted those numbers back to today's value, and we get a value of the entire company of $2.4 billion. We divide it by 163 million shares, and we get an intrinsic stock price of $15. It's trading at 366, so it's trading at a 75% discount, so it's a buy according to the model. So let's see what simply Wall Street values the company. They value it at 635. They're saying it's a 41% discount, so also calling it a buy, but just not as high as a value as I am. The stock was trading about $15 a share before coronavirus hit, so it was in line with my model, but then it's dropped like a rock down to $374. So it appears that investors are not willing to pay $15 anymore. They drove the price down to $374 because they're just not comfortable with the future of the company. Let's look at their financial ratios. Really low PE, great PE of 1.6, that's price of stock over earnings per share. Pretty good price of sales as well, 1.5, that's price of stock over sales per share. Great price to book of 0.2, that's price of stock over book value per share. Good current ratio, it's above 1, so they can cover their current liabilities, it's 1.2. ROE, that's income over equity of 12%, that's not so great. Interest coverage ratio, that's concerning because they can't even cover their interest payments with their revenue. So they may need to take on more debt, and they're 87% debt. Let's compare them to other mortgage REITs. So I have 5 mortgage REITs I've done videos for, and this is IVR Invesco right here. And if it's green, that means they're better than the average. If it's red, that means they're worse than the average. So PE, they're better than the average. Same thing with price of sales and price to book. Current ratio, they're a little worse than the average, but they're fine. 1.2 is a fine current ratio. 12% ROE, which is better than the average, although that's still kind of low. So I guess that the industry just has naturally low ROEs. They're higher than average in debt. WMC does have a little more debt than them, but 87% is pretty high. And they're a little higher than average in market cap. They're at 597 million. The average mortgage REIT is 470 million. So, interesting company to look at. Let me know what you think in the comments. Thanks for watching.